Good afternoon. Today is September 20th. My name is Cody Bills, Director of Market Advisory and Brokerage here in the U.S. for Farmers Business Network. Today we have a special segment on margin protection. We're going to be evaluating what it is and whether or not it should be something you consider for this year's risk management plan. Joining us today to help us do the evaluation is Bruce Lantzky out of New Hampton, Iowa. Bruce is a crop insurance agent with 25 years of experience here at FBN. We also have Josh McClure. Josh is a senior market advisor and broker with FBN Crop Marketing. He has worked with a wide variety of producers across the U.S. using a number of different insurance products, one of them being margin protection. Thank you so much for joining us here today, Bruce and Josh. Hey, Bruce, let's just go to you first. I think the first question is, what is margin protection? What makes it so different?
Margin protection, it's a fairly new product. It came out in the last 6 years. What it is it's a county-based plan that you can either have as your primary insurance, or else you can have it as a supplemental policy to your multi-peril policy, your revenue protection, your yield protection type policies. And the nice thing about that is it gives you a 95% of your expected county revenue as a coverage level. The other nice thing about that is the establishment prices are established the middle of August through September, and that just ended this Friday, and we were able to lock in a price of $6.11 on corn and $13.56 for beans. The nice thing about this is this allows you to lock in your coverage today, and you won't have a premium due until next September, but it also capitalizes on some really high prices, projected prices for margin protection that the program's seen. You're not having to wait until March 1st in order to lock those prices in and get some type of protection underneath your crop.
So Bruce, what expenses does margin protection cover?
What they take a look at is they take a look at interest, they take a look at diesel fuel, and then they take a look at urea, potash, and DAP. Obviously, with urea, that's mainly for the corn, but for the DAP and potash, that's also tracked for the corn and soybeans to determine how much of an increase in expenses that they see between now and spring.
Got it. So is this a government subsidized crop insurance program?
Yep. The gross premium is subsidized to the tune of 44%. So it is very, it's nicely subsidized. And then if you do have a underlying multi-peril policy, your revenue protection, your yield protection, they provide a producer credit, which would amount to anywhere from 10 to 40% based on how closely you track your individual yields track with the county.
So Bruce, what kind of producer fits best with this margin protection policy?
This product is actually for that producer that tracks very well with the county. If the county does very well and he does very well, or even if he outperforms the county, is the other one to look at. The size of the producer really doesn't matter. Especially if you're having an underlying policy, just because of the fact that you're able to lock in 95% of that expected county revenue. You're utilizing the county's revenue to help establish a insurance price.
So let's pivot over to Josh here. One thing that market advisors at FBN do is we're able to model out both your insurance as well as your forward contracts and futures and options positions, and even your OTC products that you may have with various elevators. Can you model that out for us, Josh, and just help us understand how this changes the risk profile of a producer?
Sure. Thanks for having me on here, Cody. So the first thing I'd like to show you guys here is our matrix, right? This is the way that we think about risk on an ongoing basis. And the first picture that you're seeing here, you're just looking at the revenue. But before we actually look at any of the numbers, let's kind of look at what our axes are. So on the left side, we have the price of the underlying commodity, which in this case is November 23 futures price. Yesterday's close was 13.82, and so that's kind of our center point here. And then along the top side, we have the producer individual yield of 57.6 bushels per acre. We're looking at Chickasaw County. That is the expected county yield this year. And then along the bottom side, we also have that 57.6. That's normally the county yield. And that's usually different, but because we're looking at an average producer here in Chickasaw County, they're both going to be 57.6 bushels per acre. So now as we kind of look into the matrix, that center point in the matrix is $796. So what we're looking at is we're looking at a producer that's currently with 1382 on the board and 57.6 as his expected yield. He's expecting revenue at the moment of $796 per acre. This has a maximum 72.6 and $21 of $1,500 per acre in terms of total revenue, and that total revenue shrinks all the way down to $359 at a 42.6 bushel per acre and 842. So really wide outcomes in terms of the total amount of revenue. However, what we really kind of want to do is just figure out how revenue changes. So the next slide that we're looking at here is the change in bean revenue. And so what we've done is we've just set that center point to 0 so that we can see how much revenue falls or how much revenue is gained as we change yields or prices. And so what I really want to focus on here is our market moving from 1382 down to 1058. Not that I necessarily think that we're going to get to 1058, but it's a possibility in this upcoming year if a number of things happen. So that would definitely be a bearish outlook, right? So this is basically the market moving about $3 down, and we see that a producer has $187 per acre of negative revenue expectation. So we all know that, though, right? As prices fall or as yields fall, total new will fall. So what we're going to be comparing here is as the control group. Let's take a look at how RP 85% insurance works. RP 85% for a producer with a 57.6 bushel yield. And if we assume that the spring price is that last half of August, first half of September, would come up with a total cost for that 85% policy of about $30 per acre. And by 1058, there will be a net indemnity, right? So this is total indemnity plus the cost of the premium, a total net indemnity of $24 per acre. Total expectation then for a producer by 1058 is that his profitability will fall $162 an acre from where we're at today, but that's the worst case scenario, right? So we're looking at it doesn't matter if yields get worse, if prices get worse, we're going to have that revenue held with only $162 per acre of loss. So now let's compare that to what a margin protection policy looks like, and particularly a margin protection policy with an RP policy. So first of all, a margin protection policy in this case, and these are numbers I'm getting from Bruce, a margin protection policy today, and this is also figuring a harvest revenue option on there, which all RP policies have, unless we particularly ask for the harvest revenue exclusion. The margin protection with harvest revenue costs about $46 per acre. So another $15 on top of what that RP 85 policy would have cost. And it gives us a benefit to the downside of a maximum of $71 an acre if we assume that we're putting on an RP policy under the market. Now, in this case, we're putting on an RP 80% policy, moving that down 5% from 85%, so that there's a little bit more space for the margin protection policy to work. Bruce, can you actually jump in here for a second and explain kind of how margin protection and revenue protection works in terms of there's a bit of an either or there.
Right, exactly. One of the kind of on the indemnity side, how that works is if you have an underlying revenue protection policy, they're going to go ahead and work that in the fall. You know, you're going to harvest your grain, you're going to be short. The adjuster's going to come out and say, hey, you're short. We're going to pay you the $25 an acre. Margin protection is based off of the county's actual reported yields. A lot of times that's not done. You know, final production reporting date is not until April 29th of the following year. So in this case, 2024. So therefore, you're not going to know what the county's yield is until that point in time. And then they'll take a little bit of processing time. You're going to end up getting paid on the margin protection in June. So if it's determined that you have a $50 loss on the margin protection, but you've already collected the $25 for the revenue protection last fall, come June, you're going to get the greater of. So in other words, $50 minus the 25 you've already collected, you're going to collect $25 come June.
So what we're doing here is we're assuming that we're ratcheting down that RP policy so that we can build a little bit bigger margin protection indemnity, and basically assume that we're going to have somewhat shallow losses. So in this case, we max out around that 1058 level with a net indemnity of $71. Okay. On top of that, though, we're still going to be putting on that RP 80% policy, and that policy would be $16 an acre. Combining the two, it works out to about $62 per acre, with $71 of indemnity at 1058. But that's still continuing to build if we were to break down below that level, 950 and beyond. And finally, what we're going to look at here is a comparison of how RP 85% with its $30 of cost versus this combination of margin protection, 95%, 100%, and RP 80%, 100% kind of works. So we see that we're spending an additional $32 an acre in premium, but we're guaranteeing ourselves a much smaller loss. In this case, we're guaranteeing ourselves instead of a $162 loss in the case of RP 85%, we're guaranteeing ourselves instead of a $162 loss maximum, we're going to be guaranteeing ourselves a $116 loss maximum, and we reach that maximum loss very quickly at 1274.
So Josh, how does that change your marketing plan moving forward?
Well, the biggest thing that it does is it gives them this coverage much earlier, right? So crop insurance, right? Crop insurance is the underpinning of a crop marketing plan. It's why a producer is able to market substantially before they have harvested the crop. And in this case, it's a feature that allows them to additionally spend up on inputs when maybe they wouldn't necessarily have the security that they have a price ahead of that March 1st final average yield of the underlying futures price over the month of February for most Midwest producers. One of the things that we can do here with marketing is we don't have to sell right away. When we're looking at the potential loss that a producer might see moving into a new year, one of the things that's happening this year actually is that South America is slated to grow more soybeans than they've ever grown before. At the same time, we have China continuing to pursue a COVID-0 policy, shutting down large swaths of their economy, and in turn using less crops. So we have both greater crops coming on from South America, and we have lower use out of China, the main purchaser for the whole world of soybeans. And so there's some potential that soybean prices begin to slide, particularly if South America is having a good growing season this winter ahead of their late winter, early spring harvest, our late winter, early spring harvest. So it allows a producer to kind of remain more flexible than he might otherwise be tempted to with prices nearing $14 at the moment, when he would have had to be waiting on that crop insurance price.
Thank you so much, Bruce and Josh. Really appreciate the time that you spent with us today. This is something that you're probably not going to get all in one sitting, and I'm sure there's questions that we didn't answer on this show that you may have. So, Bruce, if someone wanted to sit down and they wanted to model their farm exactly the way Josh did this, what is the best way to get in touch with you? How could they set this up?
Well, tell you what, the easiest thing to do, there is a sales closing date, September 30th, so that's be next Friday. So the biggest thing is it's a call to action. Make sure we don't wait until the very last day to try to get some information on this. I want to educate my producers to have them understand exactly what they're getting into, why we're looking at this and doing things like that. The easiest way to get a hold of me is just give my cell phone number. It's a quick and easy way to contact me. And I'd be more than glad to work through your operation to try to get so you have an understanding of what we're trying to accomplish with this margin protection. It's 319-269-5193.
We are an equal opportunity provider. The purpose of the following material is to promote awareness of risk management concepts and to highlight risk management products, features, benefits, and availability. This presentation does not provide full details of policy provisions or approved procedures. Producers should consult with a local agent for specific details and program requirements.